Good evening, everybody. Michael Coburn here again. Thank you very much for attending this evening's webinar, our 30-minute webinar, the title of which is Pension Fund Volatility is Back. The agenda and objectives here this evening, I just want to have a quick look at what pension investment experience has been since 2008, 2009, the point at which I suppose the last financial market crash really occurred and had a pretty devastating effect on pension funds. And in that context, we're going to have a look at and have a discussion around, well, is financial market stroke pension fund volatility, is it back on the agenda and back on the table? And if it is, and if that is the case, well, just propose a couple of solutions in terms of how do you reduce your exposure to that kind of inevitable market volatility. A little bit of housekeeping before we kick off. For best audio and visual experience, I would recommend that if you have any other applications open on your PCs, laptops, iPads and the like, you might just shut them down just in case they interfere with any of the software that we're actually using. We do encourage questions. Mightn't be able to get to them all given the tight timeline that we have this evening. But if you do want to send in your questions, if I don't get to them, I will respond to you after the webinar. Quite simple, just where you see on your control panel where it says type question here, just put your question in there and press send. It comes directly to me. Nobody else will see it. And finally, just in relation to the control panel, if you just want to collapse or expand the control panel at any point, just click on the little red arrow tab on the top left, and that will open and close the control panel. For those of you who don't know, and I do see from the list of attendees here this evening, I do recognize a lot of familiar names at this stage and a lot of existing clients, and you're all very welcome. RDA, we have 4 offices, Wexford, Kilkenny, Carlow and Dublin. We effectively run 2 businesses. We have RDA Accountants, which is our taxation and accountancy practice. And then we have RDA Wealth Limited, which is our financial brokerage, of which I look after and run the financial brokerage. We have between tax professionals, accountants and financial advisors at any given time, there are about 23, 24 of us in the organisation in total. And we do specialise in the self-employed and provide a lot of specialist services to solicitors. But I suppose for the purposes of this evening's webinar, I suppose really we're just looking at the pensions arena. That's me, for anybody who hasn't met me. And for those of you who are existing clients, you will recognise the fact that it's been airbrushed to infinity there as well. I've been with our RDA Accountants here for just over 4 years. And have been working in the, I suppose, the pensions arena. My speciality really would be in pensions and wealth planning, and I've been in this arena for just over 10 years now at this stage. Just a couple of warnings. I would, I suppose, the overarching warning being that we're going to kind of look at a lot of data, pension funds, etc., etc. I don't want anybody to go out and act or take any action solely based on what we discuss here this evening. I suppose really that this is just designed to get you thinking and maybe open up your eyes to what may or may not be applicable and appropriate for yourselves. Why pensions? Just a little bit of context here. You can see on it's a bit of a busy slide here, but I suppose it's a slide I developed a number of years back for the self-employed. The inner circle being the assets and liabilities that an individual might have. So we're looking at pension assets circled in red there. Follow the circle around clockwise. And you're looking at property assets, business assets, cash assets. And I suppose what has taken a hammering over the last number of years, property assets and debt with the fall in property prices and the considerable debt that people have accumulated over the years. That's I suppose no longer as solid and as a banker as it used to be. The nature of I suppose the business world at the moment and equally applicable for solicitors in terms of, well, how do you value your practice, or how do you exit your practice, or how do you extract some value out of your practice in the long run? And then be it cash or investment assets that somebody might have. I suppose really the pension asset, in my experience, has always been something that's been neglected over the years. And really, with the squeeze on the other types of assets that an individual might have, I suppose I think it's high time that the pension assets just start to get a bit more attention from all concerned. And I suppose this webinar, which is one of a series of webinars in relation to pensions, I suppose is just to try and give everybody a broader understanding of the kinds of issues that they should be looking at with respect to pensions. So the premise of the webinar really is that financial markets and pension funds are getting an awful lot more volatile. And just looking at 2015 in terms of what's popped up since the start of the year, well, the price of oil has continued to fall, which you would automatically think is a good thing, cheaper fuel at the petrol pumps. But I suppose the downside of it can be, less profits for oil companies, which is not necessarily a bad thing, depending on your moral stance. But less profits for oil companies. The value of stock market starts to fall. Maybe employees are laid off. That feeds into the wider economy, etc., etc. And then since the start of the year, we've had constant rumours and issues and announcements of referendums in terms of the British relationship with the European Union, and there is a referendum coming up, if not next year, certainly in 2017. So that all feeds into that kind of volatility. Then not so long ago, I know most people are probably, and I certainly am at this stage, the whole Greek thing, 1 foot in and 1 foot out of the camp, I suppose. And a number of months back, it looked like finally they were either going to leave or going to be turfed out. That had a huge impact on certainly European financial markets in terms of the bond market, the stock market, and so on. And led to wider questions over the euro. And what went a little bit unknown, it kind of crept up in the middle of the Greek crisis back there in May and June. Financial markets in China started to implode as well. And that's really only started to make the front pages once the Greek deal was actually done. But to put it into context, the Shanghai Composite Index at one point fell 25% in 1 month, and that actually continued, and it fell up to about 30% in 1 month. So it is a sizable drop in a stock market, which is based in the world's second largest economy. Then the Greeks and the European Union seem to kiss and make up, but that definitely hasn't gone away. And then I suppose in the background is always the Middle East and what's happening out there, and ISIS and so on and so on. So like in a fairly short space of time, 6-7 months, a lot has happened, and that has fed through into pension funds. And the question being is, well, is this just a blip, or is it the beginning of a more volatile phase? Before I start looking at pension funds, just one quick thing. I am a believer in pension funds. I have a pension fund myself, so I suppose the reason pensions still make an awful lot of sense, I suppose, really is down to the taxation benefits of pensions in terms of they're allowable against income tax up to 40%. Once your monies are in pensions, they're free from dirt tax, exit tax, capital gains tax, and so on. And a quarter of the pension fund is tax-free on drawdown. So they are very tax efficient, but there's no point in getting all the benefit of the tax efficiency if you're losing money hand over fist once you have your pension in place. Just a little bit of background, I suppose, before we get stuck into some of the detail. Pension funds are in effect, an insurance company might run 50, 60, 100 different types of pension fund, but they are in effect all invested in a number of asset classes, either wholly in part. So for example, a cash-based pension fund, a bond-based pension fund, a property-based pension fund, etc., etc. So the basic building blocks of all pension funds are pretty much the same. I would say in this, I know I'm racing through it, but we have a 30-minute slot, so I really want to give you as much information as I can in the 30 minutes. And pension funds, across the board, all pension funds, I suppose, operating in the Irish market and across Europe now have a risk rating scale. And how it works is it's based on a scale of 1 to 7. a pension fund with a risk rating of 1 being the lowest risk rated pension fund, all the way up to 7, which is the highest risk. And you can see there an example being a pension fund with a risk rating of 1. An example might be a pension fund which is all invested in cash. So it's never going to fall by more than 1% or 2% over the course of a year. But likewise, it's never going to rise by more than 1% or 2% over the course of a year. All the way up to the 7 rated pension funds. So an example of that might be an emerging market equities pension fund, so stocks and shares invested maybe out in parts of Asia and South America, etc., where really the sky is the limit as to what might happen to such a fund over the course of a year. So the reason why volatility becomes an issue is that, well, if you're in a cash-based pension fund and you're getting 0.5% or 1% per annum, that's probably only just about covering off the fees and charges levied by the pension provider, and then you've inflation eating into the real value of your money anyway. So you kind of need about 3% per annum to stand still. So just sticking with the completely safe option really doesn't make a whole lot of sense, which kind of drives you into the other risk-rated types of pension funds. And investing for the long term, and pensions are investing for the long term, it does work. So what you have on your screen there, I've tried to make this as practical as possible. I'm picking actual examples of pension funds. I have mostly Friends First pension funds throughout this webinar, and I'm not bigging up or knocking down any particular company. I'm just picking those at random because I actually have the data, and it's easier to get the data on them. So what you're looking at there, if you just look at the blue line, rising and falling blue line, that's an international equity fund run by Friends First, tracked from April 1995 up until about March of 2015. So you can see there, it's up. If you look at the far right, that blue line, it's up 327 or 8 odd percent. So okay, the proof is in the pudding. It does actually work, and money has been made on it. But as you would expect, a pension fund wholly invested in international equities is pretty volatile. So what you can see there is the last 2 big periods of volatility in that particular fund would have been in around 01, 02, when the technology bubble burst, 9/11, all this kind of stuff, and stock markets around the world tumbled fairly substantially. And then you can see from about April 03, off it took. It behaved itself again up until about 2008, 2009. Then the financial crisis hit, and again stock markets in the world tumbled. Huge drop, and then from about April 2009, off it took again, and it has been on a pretty impressive and solid run for about 6 years now. And that's not just this particular international equity fund, but equity funds and stock market funds in general have been, as have property funds since about 2010, and bond funds up until relatively recently. So I suppose the premise being is, whether you're aware of it or not, it's been a pretty outstanding run for about 6 years now. And just to put that into context, since the last big crash in financial markets, this is just a type of pension fund which is called a managed fund, and a managed fund is predominantly invested in stocks and shares. Okay, now this is a bit of a simplification, but you can look across all companies, and you can see the performance of those kinds of generic managed pension funds over a 5-year period. And if you look at the average down the very bottom, the 5-year average is coming in at about 12.5% per annum. So that's coming up on, once you take compounding into effect and so on, that's coming up on 85 odd percent in the space of 5 years. The 3-year average higher again, the last 12 months higher again at 20%. But you can see, so it has been a phenomenal run. And then the last few months with Greece and China, it has kicked off, I suppose, a different phase. You can even see up until the end of June, the average is down about 3 odd percent in the space of a month. If that was carried through over 12 months, you're looking at 36 odd percent. So it's inevitable that a more volatile phase will commence. It's just a matter of when. It may be now, it may be in 6 months' time, who's to say, but it looks like certainly things are getting a bit more volatile. And it's something that we identified back in January of this year. We were drawing up a list of, what are the possible pitfalls for investors when it comes to investing in pensions. And the couple of items we raised are on the screen there. And some of them have happened. So Greece and the euro, that has happened. Now it will come back around again. It's not the end of the tail by any stretch. UK election happened and was actually quite positive in terms of financial market reaction. But again, there is the issue of the referendum. We did identify, and I have been banging on for about 18 months now in terms of what's happening out in China and the kind of growth that's actually out there. So that has kicked off, and we'll have a look at that in a second. And there are a number of other issues. So there are a lot of kind of possible hurdles over the next 12 months for pension investors. At this very moment in time, what's driving a lot of the volatility once we get over the issue of Greece? Well, kind of what's happening in the world's second largest economy. As I said, the Shanghai Composite Index fell 30% since peaking on the 12th of June, which is pretty outstanding. Government out there introduced a lot of emergency measures. For example, domestic investors with more than 5% in any one company were prohibited from selling shares for 6 months. The government even provided cash to brokers to go in and buy shares and artificially prop up the market. So like a lot of very extraordinary measures were put in place just to try and stop the slide. And did it work? Well, soon after a lot of these measures were put in place, it fell by another 8.5% just on the 27th of July, just gone all by itself. So that's an indication of what's happening out there at the moment. And you're looking at the world's second largest economy. So what the hell has this got to do with pensions? I hear you ask. Well, look, it's pretty basic. If there's kind of financial turmoil on stock markets in the second biggest economy in the world, well then inevitably the likes of Europe, the US, etc., are affected purely by the amount of goods and services that are exported across to China. And the stat being that in 2015, China was expected to become the world's largest consumer of luxury goods, and most of those luxury goods are manufactured in the likes of the US and Europe. So a dip in the Chinese economy equals less consumption of luxury goods, which equals less business for US and European companies, which feeds into the real economy and the stock market over here as well. So it used to be that, kind of what happened in financial markets in the US spread across the world. But now, because of globalization, that really what happens in any reasonably important market in the world really can have effects in pretty much every economy in the world as well. So then the issue is, well, if we've been on a pretty good run for about the last 5 or 6 years, and if it appears we're entering into a new, more volatile phase, well, as a pension investor, what can pension investors do about increased volatility? Kind of 3 basic rules. And some of you will have heard this before, and I know my clients who were on the webinar here this evening have heard me banging on about this for many years now. But it's important to diversify your asset types. So, you have a pension fund that's not all just invested in the stock market or predominantly invested in the stock market, where you have 70-80% in the stock market. You have to understand the risk ratings of your funds. So it repeats itself over and over again, but clients who are referred into me have pension funds, and really they don't really understand what they're invested in. They couldn't even tell you whether they're in a risk-rated 2 fund or a risk-rated 6 or 7 fund. And my experience is that people tend to be invested in pension funds that are an awful lot more risky than they actually think. And also, when you're constructing a pension portfolio, really what you need to do is make sure that not only have you got different asset types in there, but your asset types are, I suppose, what are classified as uncorrelated asset types. And uncorrelated asset types really are assets, and by assets I mean kind of a cash pension, a currency-based currency fund-based pension, an equity-based pension, but they're uncorrelated assets or uncorrelated pension fund types that tend to have their good times and bad times at different times. So it's not a question of the particular range of pension funds are all rising at one time or they're all falling at one time. That they, while one pension fund might be falling for various reasons, well, the other pension fund typically would behave in a completely different way. So then it prevents a situation whereby it's either all falling or rising at any particular point in time. And I have an example of this here. And again, I've picked Friends First for no particular reason. What you're looking at there is the blue line is a currency pension fund. So it's a pension fund that deals in currencies, and effectively it's making a bet on the behavior of certain currencies. So it's betting on the yen rising against the dollar or the dollar falling against the euro, and so on and so on. And the other fund again is our friend, the International Equity Fund, which is in the red line. So from a point there in 2008 up until the end of 2014, we can track the progress of these two funds. And what you can see is while the equity fund fell heavily in 2008, 2009, when financial markets collapsed and there was carnage on stock markets all over the world, the currency fund actually made money. So it just behaved in it had no correlation to the equity fund. And that's what I mean, is that what you want to have is that your funds are behaving in completely different ways at completely different times. And then what happens is you get a smoothed out average return of the whole actual portfolio. And likewise, you can see there in 2014, I've circled it again, when the equity fund continued to steam ahead, well, the currency fund actually fell a little bit for completely different reasons. And that's, if something is constructed right, that's actually what should be happening. So it is possible to construct pension portfolios whereby you just have these uncorrelated assets and different asset classes that behave in different ways at different times. And just to hammer home the point, this is a chart, again, looking at the example of the equities and the currency funds. But you can see there, if you pick out under the heading period, for example, third quarter 2011, almost near the bottom, when I suppose the European sovereign debt crisis happened. Which was a little bit of a wobble the first time around with Greece as to what the future held for the euro. And you can see there the minus 8.9%. That was the fall in the S&P 500 stock index. So in the third quarter of 2011, it fell by about 8.9%. But then the currency fund rose by 1.55%. So again, behaving in different ways at different times. It doesn't always behave in different ways at different times, but a lot of the time it behaves in different ways at different times, and that's what you actually want. I'm wary of overloading it on charts, but what you're looking at there is, again, if you had a stocks only portfolio along the left-hand side of the screen, whereby you had all stocks in a pension portfolio, a third being international equity, a third being Irish equity, and a third being European equity. So, okay, it's all equities, it's different types of equities, but it's all equities. And then you look at the middle section of the slide where you're looking at the heading diversified portfolio, whereby you have a third international equities, you have a third in currency, and you have a third in fixed interest, which are bonds. And go over right over to the far right hand side of the screen, and under the top heading stocks only portfolio, the maximum drawdown, so that stocks only portfolio from 2003 to a point in 2015, the worst single period of sustained drawdown was about 64%, as you would expect when the financial crisis actually happened, which is huge. But if you look at a diversified, uncorrelated portfolio, it still fell at various points, but the maximum single drawdown was about 19.8%. So it's just it's something constructed to be an awful lot less volatile. Why is this important? This looks a bit busy too, but allow me to explain. So if one had an undiversified portfolio whereby it's all, let's say, invested in the stock market, and let's say they had 250,000 invested in their pension fund or range of pension funds, and it was all focused on a very undiversified correlated portfolio. And let's say that person had a loss, or that particular construction had a loss of 43%, i.e. It fell to about 142 odd thousand. If you have a 43% drop, what recovery do you need on the 142,000 even to bring you back up to 250,000 again? So a 43% drop needs a 76% recovery on a reduced figure to bring you back up to where you started. So it's not just as simple as, well, I've lost 43%, but really the knock-on effect of that is, well, Jesus, now I need to make 76 odd percent. And if one was a pension investor, let's say age late 50s, planning on retiring in 5 years' time, and they were giving themselves a 5-year time scale to recover what they've actually lost, they would be needing to make a little shy of 12% per annum for 5 years to get that 76%. And the reason there's a bit of a difference is the effect of compounding each year. So one big loss really can write off the next 4, 5, 6 years. And chances are, if you have a big loss and the next 4, 5, 6 years is written off because you're trying to recover what you've made, well, chances are in 5, 6 years' time, once you've made it back, you've had a pretty decent run of it. So perhaps now you're into another period of volatility, which means that you're probably not going to make as much, or you might even lose again in the next cycle. So one big loss can actually follow you in terms of pension funds if you get it wrong for the best part of a decade. If you had a diversified, uncorrelated portfolio with different things behaving in different ways at different times, and the net effect of that was that you on the same 250,000, you still had a loss. Let's keep it realistic here, but you had a loss of 26%, so you're down to 185,000. The recovery needed is only 35%. So instead of because you have a smaller loss, you have a smaller recovery needed. And if you were achieving the same growth rate of 12% per annum as per the top example, you would actually recover it in the space of 2.5 years. So again, if you can cut out the big losses, even if you have relatively sizable falls, it doesn't follow you for the best part of a decade. It's actually in pension terms, it's relatively quick to make up the loss. So a couple of lessons on this. Where do you go from here, I suppose? A couple of things I think need to be done if one thinks that they might have issues in terms of the nature of their pension portfolio. The first thing you need to do is identify what funds you're actually in and what the risk rating is. And again, I go back to the point whereby a lot of people, in my experience, especially solicitors, as I deal with an awful lot of them, in that solicitors and those in the legal profession in general seem to spend so much time looking after their clients that they tend to neglect yourself a little bit. So the first thing to do is to take a bit of time, identify what funds you're in and what the risk rating is. And then make sure your pension portfolio is as diversified as possible, and that you have this concept of uncorrelated assets as a building block in the portfolio. Your ability to withstand financial loss and the time you can afford to recover the loss should guide your appetite for risk. So if you're a pension investor with 5 years to go to retirement, or at least at the point where you think you might need to access your pension, then that should dictate the nature of how you're investing your pension funds. And then even once you pick your pension funds, they do need to be altered depending on market conditions. And you should make the time to spend 30 minutes with your advisor or whomever you depend on for this kind of thing. Maybe 2 30-minute meetings each year is not a whole lot of time to devote to getting something like this right. And I would also suggest for anybody with kind of 5, 6 years to go to retirement, maybe it's worthwhile looking at the various types of capital protected pension funds that are actually out on the market now. So you do wipe out this issue of loss completely. We have a lot of clients in the legal profession, and many of them will be aware of what we do. But for those of you who don't know, we have a service whereby we will do an analysis of your pension portfolio, and we will provide you with a written report. And the written report will cover a number of items. I suppose in this vein, we will analyse the investment risk and I suppose the investment rationale and suitability of the various pension funds that you may or may not be involved in, and suggest remedial actions where we deem it to be appropriate. We will also, which we haven't touched on in this presentation, but we've done a number of webinars and presentations on this topic over the years. We will have a look at the notion of pension fees and charges and establish exactly what your pension fees and charges might actually be on your pension portfolio. We will have a look at, excuse me, the likely pension value on retirement, and look at how best to maximise the tax-free cash entitlement out of the pension, and give you an understanding of the resultant pension income likely to come from your pensions. So it's a written report. Just to give you an idea of I suppose the types of findings out of recent reports, which wouldn't be unusual. Had a client, again in the legal profession, since the start of the year, who was referred into us, and he thought, I think he thought he had about 6 pensions in place, and had a pension file like an awful lot of people. We did a report for him, contacted insurance companies, etc., and it turns out he didn't actually have 6 pensions. He had 3 pensions that he'd mislaid over the years and hadn't accounted for, which meant that his pot was actually 180,000 bigger than he thought it was going to be. And also the same client, if I remember correctly as well, also was under the impression that the range of pension funds he was in was actually kind of quite cautious and moderate, but the opposite was the case. He was actually invested in quite an aggressive range of pension funds, with I suppose the possibility of, if they didn't work out, and if this notion of investment volatility was to feed through over the next couple of years, he may have been in for a nasty surprise. So all of those issues were actually fixed. In the realm of pension fees and charges, we're constantly finding that those in the legal profession, especially because people tend to have accumulated a lot of pensions over a very long period of time, that the charging structure on some of those pension funds is quite high, and that can be remedied as well, and can amount to quite serious savings depending on what we may or may not find. And there are good stories as well. Some people actually discover, I suppose that the pensions they have are actually okay, and they're online to produce what they would consider to be a reasonable standard of living in retirement, which psychologically, at least, knowing that, takes a little bit of pressure off on the day-to-day, and allows them a little bit of mental headspace, I suppose, to I suppose enjoy what they're doing, certainly for those who are closer to retirement. The steps involved for those who do wish to avail of the service: phase 1, of which there is no charge. We will just discuss a couple of these issues in relation to your existing pension portfolio by phone, just to get a sense of what it is you might have there and the level of information you actually have. And then typically, if there's a need to proceed to a meeting, we will meet with you just to have a look at some of the issues involved. If at that point we feel we can be of service, we move on to phase 2, which is the fee-based report, whereby we will contact the various providers, pension providers, and request a plethora of data, I suppose, and analyse that data and prepare the written report. So it is and can be a valuable piece of information. For those who want to avail of the offer, or for anybody who wants to discuss any of the issues raised in the webinar, there will be, as I understand it, the option to tick a contact box on exit from the webinar, or you can contact me directly, mcoburn@rda.ie, or I am based in our Wexford office here just at the moment. And I would encourage you to contact me if you so wish. For those attendees on the webinar, my existing clients, I'd like to thank you very much for attending, and I know you've heard me speaking about this topic ad nauseum over the years, so hopefully I haven't bored you too much again, and I would like to thank you for your continued support. And as promised, I said I would keep it at 30 minutes, so that's pretty much me done. Thank you very much for attending, and I look forward to talking to you all soon. Thank you very, very much. Thank you.